Welcome to the WARR Hunt quarterly market update for the March quarter. We're recording today on Thursday, the 8th of April, and it's certainly been a very interesting time. Yesterday we had the ceasefire announced in the Middle East, and the ASX, I think, had one of its best days ever, sort of posting a 3% return, which is pretty extraordinary. It just sort of goes to speak to the volatile times we've had. During this quarter, we've had two interest rate rises, one in February, one in March, off the back of inflation, and that seems to be still an ongoing issue now with the increase in oil prices. Steve, in that context, I was just wondering if you could give us a little bit of a background as to the impact of energy prices and what's that done to markets around the world.
Yeah, Sam. So, normally in the quarter there's a couple of things going on, but in this quarter, the last quarter, there's really only one thing to talk about, and that is the escalation of the conflict in the Middle East. And it all comes down to rising oil prices. And you can see in the chart here that oil has jumped up by nearly 80% just since that conflict started at the end of February. And you're right, Sam, yesterday a ceasefire was on and markets went up and oil went down, but guess what? The ceasefire didn't really last 24 hours and our market's already going back down a little bit. So it's volatile times. So you can see that oil's up. Now, oil's up means energy prices are up. I know we're all feeling it in the petrol pump, but more broadly, the economy runs on energy and those prices are up. So inflation is up, and probably a really good way to see that is through bond yields. Normally they're a bit esoteric and we don't spend a lot of time, but in this case you can see where I'm showing the Australian and US government 10-year bond yields, and you can see how they've both just jumped up in the last quarter. So higher yields are really the market pricing in an expectation of higher inflation. Higher inflation will mean higher interest rates. To your point, Sam, you can see that in the last quarter of last year, you can see how that Australian yield curve had already jumped. So we already had higher than expected inflation. And that's why our RBA raised rates in February and again in March. So before really the conflict took off.
Yes.
So unfortunately for anyone with a mortgage, I think there's really not much chance the RBA will have but to raise rates again in May because of the ongoing effects on inflation from the conflict.
It's going to be a fairly brave call by the RBA though, so it's that extraneous shock that's causing this increase in prices, so it's more of a supply issue than demand. It'd be very interesting to see how that pans out, whether they're going to stick to the knitting and increase even further.
It is. There's a bit of a tug of war going on there that you can't really see in the yield curves we put up. And the tug of war is between higher inflation, so yields are up, interest rates go up, or a slowing economy, which is where yields will come down because there's a flight to quality and bond prices will go up. At the moment, inflation's winning that tug of war. But if this conflict keeps going and global economy slows down, then you might see the yields coming down. And again, to your point, Sam, that's exactly what the RBA are trying to balance.
Yes. Thanks, Steve, for that sort of background in terms of how energy prices are affecting bond yields. But how's that also sort of panning out in the Australian market? If we look at, say, the ASX 300, how's the market gone for the quarter and probably for the 12 months?
Yeah, so we can see there's higher inflation, so higher inflation will mean slower growth, and that's what equity markets don't like. So bond markets don't like higher inflation, equity markets don't like slower growth. You can see it went right down at the start of the 12-month period. That was early April last year when tariffs were announced and put on pause. But since that time, it's actually been pretty good until the end of February, and you can see the market down. While the media is all about markets are up, markets are down, volatility is not that high. Markets aren't bouncing around as much as you might think. And to that, the Australian market is down minus 1.6% for the quarter, and negative numbers are never good. But minus 1.6 is not that big. And the 12-month number from April the 1st until March the 31st, the Australian market's up 11.7%. That's a fantastic 12-month return.
It is, and I've sort of done a straw poll with my family, but also the advisors in the office as to where they thought the market would be to the end of March. And generally it's been everyone, it's going to be negative for the 12 months, but in actual fact it's been a very, very strong return. So just sort of speaks to the fact that we're so influenced by the current noise and what impacts that's having.
There is a lot of noise out there, but it's not having that big an effect on the markets.
So they say the world sneezes, Australia catches a cold. How has the world actually gone?
So similarly, in this chart we're showing on the left-hand side is the main developed market index, and next to that is the biggest part of that, which is the USA. So you can see the developed markets are down 6%, and the USA down 7% for the quarter. All this is in Aussie dollar terms. So there's almost a bit of an own goal going on there, saying that the US has been the hardest hit by this conflict and the rise in inflation. When you look at the other big components of the developed markets, that's Europe and Japan, yeah, they're down, but not that bad. Again, everyone's got positive returns. You look at the emerging markets, down a little bit, minus 2.8%, but they're up 17.9% for the year. So that chart, I think, really speaks into the power of diversification across Australia and global markets.
Yeah, and that's something that we've always advocated for clients. It's really trying to capture market returns, tilting those portfolios to those known sources of higher expected return and being globally diversified. So having obviously investments in Australia, but internationally, and trying to pick up those returns across the board. Thank you for watching this quarterly market update to the end of March. And as always, if you have any questions, please feel free to reach out to your advisory team.